Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Deputy Global Chief Investment Officer and Chief Investment Officer at EMEA. And we're going to discuss the outlook for 2019, including a growth backdrop, equity and fixed income markets, and the challenges ahead. Mark, how would you characterise 2018 from a markets perspective?
From a markets perspective, I'd characterise it as a year of transition and also a year of heightened volatility. I don't know whether it's because it's the 10-year anniversary of the crash or for some other reason, but I think there's been a lot of focus on maybe the length of the cycle that we've come through and people beginning to look for the next recession. Clearly, we've also seen, in terms of transition, a move away from accommodative monetary policy to tightening monetary policy as the Fed has withdrawn from the quantitative easing program. And that's obviously been a dominant feature in terms of market returns and market valuations since the global financial crisis of 2008. So that's been a pretty important feature. As interest rates have risen, that's led to increased volatility. So it's been a year of transition and a year of heightened volatility.
And now looking at 2019, what are you expecting in terms of fiscal and monetary policy and economic growth?
Well, there's been a lot of focus on this by investors and clearly a lot of concern about where US interest rates might get to and what that might mean for US bond yields and then the whole valuation hierarchy of markets globally on the back of that. I think we've seen very recently, all the data we look at is showing that the US economy will slow into 2019, and I think that will take the pressure off the need for the Federal Reserve to raise interest rates more aggressively than is currently discounted. Indeed, they might not need to raise interest rates by as much as they are currently predicting as a result of that. Little inflationary pressures coming through, and I think that fall in inflation expectations, that fall in interest rate expectations, and likely fall in US bond yields will be supportive for risk assets in 2019. So we think markets will do better in 2019 than they've done this year. We're also starting, because of the sell-off that we've seen, both in credit, core fixed income and equities, we're starting from a lower starting point and more attractive valuations. And indeed, equity valuations globally in terms of their, not just their relative range in comparison to bond markets, but also their absolute range historically, equity markets don't look expensive in our view. So I think the outlook for markets next year is brighter. There are risks, and I know we'll come to those later, but I think the outlook is brighter for markets as a result for 2019 because we don't think interest rates are going to be raised aggressively.
Yeah, and will we see geopolitics continue to take centre stage again in 2019?
Well, I think with the US administration that we have, I think geopolitics are going to continue to dominate because they have such macroeconomic impacts. The trade sanctions, the fiscal stimulus that we've seen have dominated market returns in 2018. Closer to home, we've still got Brexit rumbling on, and that's going to have a market impact potentially affecting sterling asset valuations. We've got geopolitics rumbling on in Europe with the Italian budget and the potential for more populist uprising. So I think geopolitics are going to be a feature for the medium term.
Now, drilling down into individual asset classes, how do you see equity and fixed income in 2019?
So starting with equities, I think equity markets look more attractively priced. I think corporate profits are continuing to grow. Equities continue to behave in equity-friendly ways, so corporates continue to retire equity and take each other over. So I think that's supportive. Valuations are lower, and I think earnings growth will be 5 to 10% in most places. And as I said, the starting point is a lower one because of the sell-off that we've seen in the second half of 2018. Within credit spreads are now wider, and I think there is the semblance of some value emerging there. And within US core fixed income, I think Treasury yields are more attractive than they've been for a long time. I think, closer to home, I think UK and European core fixed income looks less attractive, but I can see some value in credit in Europe, as I've already said.
And finally, what do you see as the main challenges and risks in 2019?
The biggest risk I think the world faces from a financial returns perspective would be the Trump administration looking to do an additional fiscal stimulus to keep the US economy growing above trend. Above trend growth in US GDP is pretty important to the president, and were he to seek some additional measure to stimulate the US economy next year, I think that would raise very big red flags to the Federal Reserve in terms of the potential inflationary consequences of that. They would raise interest rates more aggressively, and as we've been discussing, I think that would undermine valuations globally on all asset classes. So that's a risk. Second risk would be that the US finds itself 10 years after the beginning of the upcycle with a structural deficit of some 7%. The fiscal stimulus has been an expensive thing to implement, and they don't have a lot of firepower in reserve were the economy to turn down more aggressively, and they need to stimulate somehow. So that's a risk. Brexit remains a risk. The trade tensions between the US and China remain a risk, and Eurozone politics remain a risk. So the risks are many and varied. So I would describe our stance as sort of nervously optimistic about the outlook for risk assets. Valuations are supportive, but there are risks out there that we need to make sure that we're aware of when we're putting portfolios together.
Mark, thanks very much.